Hello students, welcome to Accounting Explained at Accountwise Academy. This is Latha Venkateshwaran. My dear students, today we are going to learn about rules of debit and credit and the golden rules of accounting. In our previous video, we laid the strongest possible foundation by understanding the accounting equation where assets is equal to liabilities plus equity. We saw how every business transaction keeps this equation in perfect balance. But you might be wondering, how do we actually record these transactions to maintain this balance? Well, that's exactly what we are going to learn today. We are moving from the what to the how. And the answer lies in two of the most fundamental and often misunderstood terms in accounting. They are the debit and the credit. Understanding debit and credit. Let us be very clear from the start. In accounting, debit and credit do not mean good or bad. Okay, this is wrong. And they certainly do not mean increase or decrease. This is also not wrong. Think of them as the left hand and the right hand of accounting. They are the two equal and opposite forces that ensure our accounting equation always remains in balance. Okay. For every transaction, the total debit must always be equal to the total credit. So debit should always be equal to the credit for every transaction. This is the non-negotiable rule in the double entry system which we are going to learn now. What do debit and credit do? Debit entries, when there is increase in assets and expenses, and when there is decrease in liabilities, equity and revenue, then we have to pass debit entries. Credit entries, when there is increase in liabilities, equity and revenue, and when there is decrease in assets and expenses, we have to pass credit entries. When you see this like this, you're going to be confused. I am going to explain this with the table so that you'll be able to understand it very easily, and I'm going to explain this with examples. Okay, so in this table we have three columns. They are account type, debit entries, credit entries. First, let us take assets. When there is increase in assets, example cash, inventory, etc., we are going to debit it, or else we are going to pass debit entries. Suppose for your business you are buying machinery worth rupees 2 lakhs. It means your asset value is increased. So when the asset value is increased, you have to pass debit entries, right? So machinery account will be debited. Okay. Next, decrease in asset. When there is decrease in asset, then it has to be credited. Suppose you're going to sell the same machinery. In that case, what will happen? Your asset value is going to be decreased. If there is decrease in the asset value, then we have to credit it. Now, while selling the machinery has to be credited. Okay. Next, let us take expenses. Increase in expenses. Increase in expenses means we have to pass debit entries. Examples for expenses are rent, salary, etc. Suppose you are going to pay rent, or when you are going to pay salary to your employees, then we have to debit rent and salary. Okay. Next, decrease in expenses. When there is decrease in expenses, we have to credit. Okay. Suppose you are buying goods from the supplier. You're purchasing goods from the supplier for rupees 1,50,000. So purchase is an expense, it will be debited, right? You find some goods worth rupees 25,000. It's not of good quality and you're returning to the supplier back. So this is your purchase return. Okay, so you understood this, right? Purchase is an expense. So this will be debited. Expense increase in expense. That is why it is debited. When you're doing purchase return, there is decrease in expenses. Why there is decrease in expenses? Because to the extent of 25,000, you are not or you will not pay because those goods are not of good quality and you have returned it. So decrease in expenses means you have to credit. So purchase return will be credited. Clear till here? Clear. Next, we will go to liabilities. First, I'll explain you what is increase in liability. When there is increase in liability, it will be credited. Suppose you are going to take a loan of rupees 5 lakh, okay, for your business. So loan is a liability. When there is increase in liability, what you're going to do? You're going to credit it. So loan account will be credited. Okay. When there is decrease in liability, you are going to debit it. Suppose you are going to pay 5 lakh rupees back. Then there is decrease in liabilities. So loan account you are paying, so your liability is now becoming nil. In that case, loan account has to be debited. Okay. Next, owner's equity. First, I'll explain what is owner's equity. Owner's equity or capital are almost have the same meaning. Okay. Owner's equity or capital. When the owner brings into the business, then brings money into the business, then your capital increases. But in real world, business and the owner both are considered different. They are not same. So when the owner brings into the money into the business, then the business is liable to pay back the owner. Okay, when the business is closed. So the capital or owner's equity is considered as liability to the business. So we have to treat owner's equity or capital as we treat the liability. So when there is increase in owner's equity, so when the owner brings in capital, that is owner's equity. No, so when the increase in owner's equity, we have to credit it. Similarly, when there is decrease in owner's equity, it has to be debited. Suppose owner takes back some of the money which he has brought in as his capital, then capital account has to be credited, or sorry, debited. Capital account has to be debited because he is taking the money back. So the liability to the business is reduced. Okay. Suppose if he is taking it for personal use, then it is called as drawings. In that case, drawings account will be debited and capital account will not be debited. Okay. If he's taking it for personal use, then it is called drawings, or else if he's taking out some of the money from the business, it is capital. Okay. Next, decrease in revenue or income. When there is increase in revenue or income, first we'll see the credit side. Okay. When there is increase in revenue or income, then we have to credit it. So example are sales, interest you receive from the bank, or some professional fees which you'll receive from some of your customers when you have rendered some professional services to those customers, or when there is a loan you have lent to others and that interest you are receiving. All these things are revenue. So all revenue should be credited. When there is decrease in revenue, this is similar to the purchase return we saw. No, the same way. Suppose you are making a sales to your customers for rupees 2,50,000 and the customers feels goods worth rupees 5,000 or of not good quality, and they are returning the goods to you. So sales means increase in revenue, so it will be credited. Sales return means decrease in revenue, right? You are not going to get this 5,000 rupees back. So sales return to be debited. Okay. So I sincerely advise you to by heart this table so that it will be very easy for you to do journal entries, or after that when you do the ledger posting, when you prepare the trial balance and financial accounts, all these things will be very easy when you are thorough with this table, because this is the strongest foundation for double entry system of accounting. Importance of debit and credit. Maintains balanced financial records, forms the basis of double entry accounting system, helps in error prevention and detection. Let's see these 3 points in depth. Okay. The rules of debit and credit help keep every transaction balanced. The rules which we saw, no, that helps us to keep the financial records balanced. Next, they are the basis of the double entry system. Double entry system means total debits should always be equal to total credits. Next, this system not only helps to maintain accurate records, but also serves as a check to prevent mistakes. Okay, let us see what is golden rules of accounting. It simplifies debit and credit rules by classifying accounts into personal account, real account, and nominal account. Each type follows particular debit and credit rules, making them easier to remember and apply. Now let's see the classification of account types. First is the personal account. See, the name itself says that personal account relates to persons or entities. Examples are customers, that is debtors, suppliers or creditors, owners, etc. Real account. Real account is related to tangible and intangible assets. Tangible assets are those which you can see, and intangible assets are those which you cannot see. Examples are machinery, furniture. These are all tangible assets, and patents, copyright, trademark are all intangible assets. Okay, next comes your nominal account. This is related to incomes, expenses, losses, etc. Examples are salaries, rent, sales. Here are the golden rules of accounting. If it is a personal account, debit the receiver and credit the giver. If it is a real account, debit what comes into the business, credit what goes out of the business. Nominal account, debit all expenses and losses, credit all incomes and gains. Along with the previous table, you have to by heart this table too, because these two tables are the strongest foundation for financial accounts or the double entry system of accounting. My dear students, if you like my video so far, give a thumbs up and subscribe to my channel, Accountwise Academy. This will encourage me to make more videos in the future. Let us take some practical examples to understand personal account, real account and nominal account very easily. First, I'll take this transaction. You bought goods on credit from Mr. Sharma, rupees 50,000. First, remember bought goods means it is always purchases. You should not take goods. When you are buying goods for business, it is always purchases. Okay. On credit, you are not paying now, you are paying in the future. So that also should be considered. And you have bought goods worth rupees 50,000 on credit. Okay. Now, let us see this purchases. Purchases is an expense. So the rule of expenses, debit all expenses and losses. It's a nominal account. So purchases account should be debited with rupees 50,000. Okay, got it? Next. Next is your credit thing we have to take. So we have bought goods from Mr. Sharma. Mr. Sharma is a personal account. Mr. Sharma is giving you goods. So the rule of personal account is credit the giver. So here Mr. Sharma will be credited with rupees 50,000. Next, we are going to see a transaction on real account. You purchase machinery worth rupees 80,000 in cash. So you are buying machinery for rupees 80,000 and you are paying that by cash. Here, both machinery and cash are real accounts. Okay, first let us take machinery. Machinery is a real account. It comes into the business. So the real rule of real account is debit what comes in. So we have to debit machinery with rupees 80,000. Next, you are paying cash for buying that machinery. Cash is also a real account. So here cash goes out of the business. The rule of real account is credit what goes out. So we have to credit cash account with rupees 80,000. Let's see an example for nominal account. You pay salary of rupees 10,000 in cash. So first let us take salary. Salary is an expense and it's a nominal account. So the rule of nominal account is debit all expenses and losses. So which is has to be debited with rupees 10,000. Next, how we are going to pay salary? By cash. Cash is a real account. Here, when you pay salary, cash goes out of the business. So we have to credit cash account. Rule of real account is credit what goes out. Okay. So cash account has to be credited with rupees 10,000. In this way, you have to analyze each and every transaction with the golden rules of accounting, and you have to see whether the particular account has to be debited or credited. One thing, if you see here, when we debit account with one amount, we will parallelly credit another account with the same amount. Here, debit and credit are always equal. Okay, so that is the double entry system of accounting. Total debit should always be equal to the total credit. See here, you have debited 10,000. Again, you have credited rupees 10,000. So, here we have fulfilled the rule of double entry system of accounting. In this way, you have to analyze the transaction. Let's have a quick summary of what we have learned so far. We have learned rules of debit and credit and ensure that we have a balanced and accurate accounting. Okay. Next, we have learned about golden rules of accounting, which will help to simplify these by categorizing accounts. That is personal account, real account, and nominal accounts. I would sincerely advise you to do consistent practice with examples, which will lead you to be a confident person to pass any journal entry in your exam and get mastery over the subject. Thank you for learning with Accountwise Academy. In our next video, we will demonstrate how to pass journal entries step by step using these rules. Don't forget to like, share and subscribe for more simple, effective accounting tutorials. If you would like to inquire about the online classes which I take or to get more worksheets, you can contact us at acc.wiseacademy@gmail.com.